Hey there, folks. This is Mitch Firestone at Precision Trading Labs in New York City. I want to share with you a couple of trades that we had today with our community members and subscribers, and then I'll also show you a setup that we're actually waiting that's actually waiting to trigger. Um, what we're looking at here is a 3-hour chart of the micro futures for the euro. The reason that we actually trade the futures as opposed to Forex is it gives us a lot more flexibility in terms of other instruments. Obviously, trading Forex is great, but at that point, you're limited to trading currencies. On the other hand, if you're trading the futures, you can be trading currency futures, but you could also be trading gold and oil, equity futures, bonds, all that kind of stuff. So that's why we kind of gravitate towards that asset class. So that's why we're actually looking at the currency futures here. So we're looking at a 3-hour chart here, and this is an area of interest where we're actually waiting for price to pull back into this zone in order to have a long trade. Okay, so what's interesting about this region here? Well, price came up into here, and again, we're looking at a 3-hour chart, so this is about 12 hours of trading activity in here, obviously. So price came up in here and then consolidated in this region here. And then notice price rockets out of there with this string of larger green candles here, okay? And so what went on in here was, if you think about the shares that are acquired by buyers, we could think of that as the demand for shares. Similarly, we can think about the shares that are offered up by sellers. We can think of that as the supply of shares. So within this area here, supply and demand are in balance. Okay. And of course, we need supply and demand to be in balance because that's the only way a trade, of course, is going to happen. But then at some point, it goes out of balance in this region. And so the only way that these trades occurred was essentially buyers ran up the price chart until they encountered willing sellers. Okay, so right here we had what we can think of as an exhaustion of sellers. No one was willing to sell here anymore. And so once the supply of shares leaves this region, all that's left in its wake is demand. Hence, we call this a demand zone. Okay. And so the way we play a demand zone when it's fully qualified in terms of how price enters it, how price leaves it, and then the structure of what's inside of it, if it meets various qualifications, what we're waiting for is for price to then pull back in anticipation of another round of buying. Okay. So we're actually thinking of that this zone offers up essentially untapped buying pressure that we're waiting to be what we're waiting to take advantage of. Okay, and so right here, this is a rally-based rally formation. It's a continuation pattern, and so when price returns here, we were anticipating another round of buying. Okay, so this is something that I had shared with our subscribers and our community members yesterday. And so this was we were basically waiting for this trade to trigger, either today or tomorrow, whenever price actually pulled back here. So as it turned out, overnight, price in fact did pull back here. Okay, it actually kissed right off of the front line of this zone here, and then we got this nice bounce up here, and then this is where the trade we basically took the trade off here. Why there? Because essentially up on top here, we basically saw an exhaustion of buyers. Okay, the same way here we had an exhaustion of sellers. Here was a sudden exhaustion of buyers with a great deal of bearish energy. And so when price came up to here, there was the thought that this might be a logical place to take the trade off because in fact, price could in fact actually then stall or even reverse up here. And so at that point, though, it was a reasonable trade. You can see right here, our risk here was 23 ticks, and at $1.25 for the euro, for the micro euro. That meant that we had a risk of $29 a contract. So if you hypothetically, if your trade plan allows you to, let's say, trade $200 of risk per trade, if you think of this as a $30 risk contract, well, then that would allow you to trade 6 micro contracts if your risk profile was $200. Okay, so that's how that works. So for people, let's say that traded six contracts on this, they were risking about 180, and when we got up to here at just over 2 to 1, they obviously made about $660 off of that risk profile. So anyway, that was the setup and the and how it played out with the euro. Also over here we can see there was a secondary way to play this. Also, rather than taking it at this high front line, you could take this at the body of this candle, and at that point it was a $22 risk trade. As you can see, though, had one done that, you would have missed the trade because, in fact, it did hit off the front line, but it didn't make it all the way back to the body of that candle. So, but that's a trade-off of risk reward versus an opportunity cost. So, at any rate, that was that setup for the euro. We also had another nice trade here. In fact, here's the wrap up for the trade here, and we can see again 48 ticks, and that was $60 a contract. Okay, so we had another trade here now. This is with gold. Okay, and so I had actually laid out two distinct setups here. This was a long setup down here, where again we had a demand zone here, where price came down here, consolidated, and then notice then it rockets out of there after this string of kind of indecisive candles here that all kind of close pretty much relatively sideways there, and then we had that exhaustion of sellers that occurred there. So that was the basis for this long setup, and then similarly up here we had a short setup, which is essentially more or less a mirror image of this, obviously inverted. Okay, right here we had a rally base drop formation. Again, price consolidated there. We had this little this very bearish but indecisive candle here, where it more or less opened and closed pretty much where it opened, and then right here you can see two very bearish candles there. Okay, so we were then waiting for price to return to this region, and then this is where we'd be shorting the micro gold futures. And again, this was a 3-hour chart here. Okay, so the depth of this zone with the stop was $14.70 in terms of the price of gold, and at that point, then our risk profile on that. Let me just move this over here so we can see the entire chart there with the axis here. So $14.70 of the price of gold, that's 147 ticks. And since we were trading the micro contract at $1 a tick, obviously each contract had $147 of risk. So for a lot of our subscribers and community members, they traded a single contract. Since then, but on the other hand, we do have a few people that trade. Let's say, that are, let's say, allowing themselves $500 per trade, and so at that point, then they were actually able to trade 3 contracts in that particular case. Okay, so we were waiting now for price to come up here. This was a supply zone. Again, this is a place of untapped selling pressure, and when price got up to here, this is where we were looking to take a bearish trade. Okay, so that's the setup, and so we can see right there. Here's where we were just looking at. Okay, prior to that, we had this quasi near miss, but then eventually overnight, price came up here again, kissed off the front line. And basically over the course of, I don't know, maybe about 3 or 4 hours, I can't recall, but price came down here and then dropped here. And then that's where we got out. And that was basically a 2.5 to 1 trade there. Okay. So again, we got in with 147 ticks of risk, and we got out with 366. So that's 2.5 to 1, and at a buck a tick, that's 200, and obviously, actually, there's a typo there. Sorry, that should be $366 per contract. That was our profit there. Got to correct the typo. So at any rate, that was that setup. So let me show you now a setup that we're actually waiting on here. So here is a chart of the New Zealand dollar. Okay, and so we're looking at a 1-hour chart here. So let me just spread this out just a bit here, and right here we have this drop base rally formation. Okay, this should start to look a little familiar just because of what I just showed you on the gold contract here. And so price came, in fact, this is pretty much the same pattern here. So we had this drop base and then a rally. Notice again, we had these indecisive candles, prices going sideways. We had this bullish candle that fires out of there. And so at that point now we're waiting for price to then pull back into the zone where again there is untapped buying pressure that we're anticipating. Okay. And of course, if this is trading, all the trades, of course, do not work. So here is our entry, but this is where our stop out point would be if in fact things did not go our way. So we can see right here, the depth of the zone here went from 47 to 50, from 47 to 54. That was 7 full ticks, and then we were going to give it an extra 4 behind the zone for our stop. So at that point now we have 11 ticks of risk at $10 per contract, $10 per tick, and so that's $110 of risk per contract. So that's what we're looking on for the New Zealand dollar. So we're waiting for a pullback into this demand zone here. So let me just kind of shrink this down again so we can see where we are in terms of price at the moment. So you can see right now, price is now sitting up here. So we need for it to obviously pull back here. And so, in a sense, we're waiting for the trade to come to us. So under normal circumstances, that's just what we would do. We would set an alert, let's say somewhere here, and then if and when price comes back here, we would then reevaluate it. But if everything is if everything is still checks out, then this is where we would get into a bullish trade and buy the futures. The interesting thing though is we actually have something else we can do here. Again, we're looking at a 1-hour chart here, and if you notice, price kind of spiked down there with that ascending wick here, and then notice price then dipped in here again, came back again, dropped again and bounced, dropped again and bounced, dropped here, just barely wicked through, and then rebounded again. So you can see this is clearly an area of support. There was never any demand that I would have certainly gone long out of here, but we can see in retrospect, this is a clear area of support. And so what we're waiting for here, depending on how, if price actually kind of breaks this here, is this could actually set the stage for a breakout trade to the downside, a bearish breakout trade. And so what we would be looking for is first for price to actually take out this last vestige of support here, okay? And then after that, we would basically be looking for price to perhaps dip another, let's say 3 or 4 ticks down to here. And then this is where we would get into we would actually get into a bearish, we would short the futures at this point and basically look to ride it down to this area of demand, which would be a place where effectively we would almost think about almost hitting with the reverse button. We would get in here to hopefully have a successful bearish breakout trade, and then actually get into a bullish trade out of this demand zone here. The way we would actually get into this trade, though, we don't want to see price just kind of sneak up on this trigger point here, which is 57.5576. We would actually want it to basically come down with a great deal of bearish energy. So what I would probably do is, we're looking at a 1-hour chart here. I would probably drop this to about a 15-minute chart, and then monitor how price comes up, approaches this. In a perfect world, what we would be looking for is we would want to see a candle that looks something like this. In other words, a very, very bearish candle here. And what we would look for is for price to, basically go through here and then actually close at the bottom of its range on a 15-minute candle, taking out this this lower wick here, and then actually going through here, and then get into the trade somewhere here. We don't want to see it kind of sneak up on this. We actually want to see it kind of hit it hard with bearish energy. But if that does occur, then we could play the breakout. So that's what we're waiting for here. The way that trade would get set up is this would be our entry approximately, depending on where that candle closes. At that point, then this is where we would get in. We would set our stop just behind this zone here, which was formerly support, and then we would put that there. So at that point, we could see that the trade was from basically 12 ticks of risk here. You can see right there, there's 12 ticks of risk. So that'd be $120 worth of risk. And to get down to here, that would be 18 ticks of profit. So it's not an all-star trade here. Oh, excuse me, 22 trades, 22 ticks of profit here. So it's not an all-star trade. We were generally looking to get at least 2.5 to 1. So this is obviously a little less than 2 to 1. So it's not an all-star trade, but it's a reasonable setup. So that's what we'd be looking for. That's what we'd be looking for on here. All right. So we'll be waiting to see what happens with that. So again, we have two setups here: this bearish breakout trade, and then this bullish uh, uh, trade out of demand. Okay. So the last thing here is all of these trades that I've just shown you. These are all being shared with our subscribers who are part of our funded trader program. And this is a program that PTL is running where we help our subscribers to qualify and gain access to a funded account where they don't have to put up their own money to trade. And I'm sure a lot of you are aware of these companies that do that, where essentially you earn a funded account, you then keep approximately 90% of what you earn, and then of course they take 10% of it, and so that's how these things work. So we actually have a program that we essentially help people step through that program, and so this is the basically the core of it here, and these are the various elements that we go through. So if you check off in the description of where this video is, if you check off the link there, click on that. You'll get access to a path to learning about our funded trader program, and basically get put on a path to earning a funded account. Also, if you would please subscribe to our channel so that you're aware of other videos that we put out, as well as specifically setups about the futures that like what I just showed you, that would be great. All right. So at any rate, thank you for joining me. This is Mitch Firestone with Precision Trading Labs, and I will see you next time. Take care. Bye-bye.